The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody, and welcome to Policy and Practices webinar this morning. Today's webinar is titled Understand How Universal Credit Affects Council Tax Reduction Schemes, and we're delighted to have so many people here on the webinar today. We know it's proven to be an extremely popular topic. Before we start, and before I introduce you to today's speakers, I'd just like to do a little bit of housekeeping, if I may, very quickly. If you could, if I could just check the audio, please, if you could look at the panel on the right hand side and raise your digital hand for me, that will let me know that you can hear us. Okay, thank you very much, everybody. And in the same panel on the right hand side, you will see there is a section there where you can type in your questions. So please do type your questions in as and when they come to you during the webinar, and there will be time at the end to put them to our speakers. We'll have a couple of polls and also a survey at the end for you to ask for more information. There's a download available in the panel on the right hand side about the service we're talking about today, so do take a look at that, and we will have you on your way by 11:30, which means we have a lot to get through. So without further ado, I will tell you, for those who don't know us, just a tiny little bit about Policy and Practice. Policy in Practice, we're an organisation who believes the welfare system can work better. We know that the system, as indeed you do, the system is complicated, and different government departments administering a range of different benefits, each with their own set of rules. So we were founded to help people towards financial independence by making the welfare system simple for people and organisations to understand. We're a policy-led software and consulting business, and we've developed 3 core services to make the welfare system simple to understand. The first is our benefit and budgeting calculator software, which many of you may be familiar with. The second is our data analytics service. And thirdly, we have our data modelling service, which is what we're talking about today. So that's all I'm going to say about Policy in Practice. Because the most interesting bit, I think, is to introduce you to today's speakers. We have my colleagues Zoe Charlesworth and Juan Alvarez Villanova from Policy in Practice. If you would just like to say hello so that people can recognise your voices. Juan?
Hi, everybody.
And Zoe?
Hello, good morning.
Thank you very much. And also we're delighted to have Jenny Hoare from the City of Wolverhampton Council with us as today's guest speaker. Jenny, would you like to say hello?
Morning, everybody.
That's great, thank you. Okay, so today's agenda then, Zoe's going to give you a background to council tax reduction schemes and talk about some of the trends that have evolved since 2013. Zoe's going to be talking about objectives of CTR schemes and most importantly, the impact of universal credit. Then Jenny and Juan are going to talk about specifically about Wolverhampton City Council's scheme and the experiences that have been happening there in Wolverhampton. And then Juan is going to talk about 4 different approaches that we've worked with different clients on modelling CTR scheme options, just to take you through a little bit of that as well. And as I say, there'll be plenty of time for questions and answers at the end. Okay, so that's my brief introduction done. I'm now delighted to hand over to Zoe.
Oh, thank you, Janet. Hello. I'm not going to spend too much time looking at how we got to where we are now. I mean, everybody's aware of this, the localisation of council tax. Just if we're looking at the impact of universal credit, it's really quite useful just to remind ourselves that most authorities at the moment are still using schemes that are based on the default regulations. So we've got just a little picture here showing the changes since 2013 to 17-18, and really it's just been tinkering around the edges around band caps, savings limits, minimum payments, and the majority of local authorities have made changes to schemes, but nothing really radical. Go to the next slide, Janet. Actually, we're going to just have a poll because we are very aware that a lot of people are looking at scheme change. I mean, that's testimony to the number of you who are here today. So we're going to just try and find out what your objectives are.
Lovely. Thank you, Zoe. So this is hitting the ground running. It's a very interactive session today. So this poll, which should be coming up on your screen shortly, is titled, we're asking you, what would your main objective be if you were changing your CTR scheme? Okay, so I'm going to give you time to take the poll. So please, just if you could choose from the options, is your main objective, and of course you may have more than one, is your main objective to reduce the cost of the scheme, for example, reducing the benefit or the discount that you offer. Secondly, reducing the administration costs for the authority. Thirdly, reduce or indeed avoid increasing arrears or cost of collection. Fourthly, align support with universal credit, or finally, reduce poverty. I can see everybody voting as we speak, so it's great to see. I shall give you just a couple more seconds for you to make your mind up. Appreciate it's a tough one because then you may have dual objectives. So, okay, great. Thank you very much. So I'm going to close the poll now, and I will share the results, which you should be able to see on the screen now.
Yeah, and I think, Janet, I think this is more or less exactly what we expected. I think what's really interesting is if we had done the same poll a couple of years ago, even perhaps last year, the main one would be to reduce the cost. When we were going into authorities looking at scheme modelling 2 years ago, even a year ago, the first thing everybody said was we need to reduce cost because of the pressure on local authority finances. And we are now finding that the main emphasis is on administration costs, aligning support with universal credit. And I think this goes really nicely onto our next slide. It really, really illustrates exactly what we were seeing when we were talking to local authorities. So these are the impetus for change that we were seeing up to this point. And as I said, the main one up to now was usually reduce scheme costs. The other people wanted to promote work incentives, align with universal credit, and align with universal credit can mean different things for different local authorities. For some, it can mean the same objectives of universal credit. For others, it can mean supporting those who are badly impacted by universal credit. So that has a sort of dual meaning. And the really important point about this is that from about 6 months ago, the impetus for scheme change was focused entirely on migration to universal credit and making admin savings that go along with that. So that's what I'm going to focus on, and I'm also going to focus on what if you do keep the default scheme. So the impact of universal credit on the default scheme. So I'll move on to the next slide. So why are people looking at introducing a new scheme with the move to universal credit? One of the reasons we're hearing is that residents will need to reevaluate their household income anyway, and council tax support can be part of this. It also, such a big change, and local authorities, if they're introducing a new scheme, can do it partially. They can move certain people over to the new scheme as they move onto universal credit, and retain the others on the legacy scheme. Which is a nice way for staff. It does obviously necessitate running two schemes side by side, but it's also a sort of test and learn process. So I mentioned a scheme to go alongside universal credit can mean two things: supporting the aims and objectives of universal credit, or supporting those who are impacted by universal credit. There is always the opportunity to use the universal credit assessment as your income assessment, which is really can reduce the amount of work being done by local authorities. And I think a lot of local authorities are looking to scheme change to take advantage of this. They will open their scheme to everybody who's on universal credit, exclude those who aren't, and use the DWP's assessment of income. There is this, I think it's also exercising people's minds, the cost of admin against awards once housing benefit is removed, and the number of reassessments that will come into play with monthly universal credit changes. And obviously RTI feeds into that. We've got some very interesting figures on this. If you want to move to the next slide, Janet. We actually did an internal data analysis just for our own information, looking at a site that's been full service for a year. And the number of reassessments was doubled. It's actually slightly more than doubled, but we've rounded up here. So if you just keep the default scheme, don't put in any sort of method of minimizing reassessments, you can expect to see assessments of ongoing changes within a year doubling. So move on, Janet, to so we haven't just got this reassessment going on, the increase in reassessment. There is going to be the reduction in cross-subsidy from Housing Benefit Administration. As you probably know that when council tax administration cost was absorbed into the local government settlement, it was at just something like £11 a case. So they've always been cross-subsidised by Housing Benefit Admin support. As that goes with universal credit, the cost to the authority is going to be much greater. And the proportion spent on administration probably made sense with a housing benefit claim. These were the rental element is usually the biggest part of anybody's out of work benefits. The cost of a claim, which I think the DWP sort of calculated as about 167 admin per claim per year, would make sense if you're paying out £300 or £400 a week for somebody's rent. Doesn't make so much sense when you're paying out £10 a week for CTR. So we've worked out that admin costs may end up being up to 25% of the total costs of CTR once housing benefit leaves and we're looking at standalone cases. So this is really, really exercising local authorities' minds. Yes, I'll move to the next. So how do you reduce admin costs? When we're looking at admin costs, when we do modelling for local authorities, there's three things we look at: the number of claims, the number of reassessments, and the complexity of assessment. The number of claims is, most authorities not really wanting to reduce the number of claims, because reducing your number of claims, all these households on low income will obviously have an impact on arrears and collection rates. And most authorities would like to help those on low incomes. There's likely to be a drop-off anyway, in some areas, some not, as people move to universal credit. And there's also a drop-off because people were omitting to claim council tax support under universal credit, although all the information we have on this is that that is being steadily getting better. Those local authorities went full service very early on, saw a larger drop-off, and the DWP are getting much better at informing people that they need to contact the local authority to also claim council tax support. The number of reassessments, as we've seen, they can double, and you can introduce scheme designs to reduce these, either through de minimis rules, or what we're seeing a lot more of now is local authorities building averaging of UC into their scheme design. So like currently where benefit is awarded for a certain period based on average incomes, they're going to use average UC. And I think that's the way we can go. And I know that software suppliers are now getting on top of this and introducing ways that local authorities can either introduce de minimis rules or other methods of limiting the number of reassessments. The complexity of assessment is something that can certainly be built into scheme design. And I think this is what an awful lot of local authorities are looking at. Either using the universal credit income as your the income, or basically using the default scheme, but taking out certain elements such as tariff income and non-dependence. Move on to the next slide, Janet. Right, so yes, you can reduce admin costs either through having a whole scheme change in a radical approach, or by reducing it within the default scheme. But let's just remind ourselves what the default scheme is under universal credit. It's very similar to the current scheme, but the UC max replaces the applicable amount, and income is the income for universal credit plus the amount of universal credit, and there's no earnings disregards. But generally, the outcome will be that the cost to the authority as a whole will be slightly less than legacy benefits. But we've seen huge variations here, and this absolutely depends on local characteristics. It will depend on the number of people in employment and self-employment. There is a big variety here on the cost impact. Households not in work are unlikely to see a difference in support, but the majority, and we'll come on to the exceptions of households in work, will receive lower CTR, but this is because they're receiving higher universal credit with a retention of the 37% of income. So the overall message from this is that sticking to a default scheme will not be neutral. So even if you stick with your current scheme, you are making a decision as you go into universal credit. It's not that as people move to universal credit, their CTR will remain the same. It won't. It'll be different anyway, even if you keep with the default scheme. Next slide, please, Janet. So why do some people CTR change? It's because if the needs is lower under universal credit, this is for people who will get lower UC and lower CTR. And these are the people I think most local authorities are concentrated on, because if the whole household income is shrinking, this will have implications for support services throughout the local authority, but also on arrears and collection. And we'll see this happen if the needs is lower under universal credit, or the income that's taken into account is higher, and the obvious example there is the self-employed. So some households will lose, some will win, some will see no change. And it's really difficult to give a rule of thumb on this, because how much this will affect your authority, how many people will be left worse off with lower UC and lower council tax support will completely depend on the characteristics of the people within your area. Yeah, move on to the next one, please, Janet. Some people will lose an awful lot. And this is, we've got a worked example here, and this is a single parent, and her household income with, before she moved to universal credit was 1762, and afterwards was 13. So she's losing about £400 a month. But as you can see, her universal credit has gone down, but her council tax support has also gone down. In fact, she's lost it all. And the main groups this will happen to are employed households with a disability, self-employed households. I think we're all expecting that, and lone parents. Now, the lone parents is a really tricky, because at some points as their income rises, if they're working, they're better off. Under 16 hours, they'll be better off on UC. Then they go worse off as they approach 30 hours. They're better off, and then as they just go over 30 hours and you lose the additional element of tax credits, they're worse off. And then as they move more hours, they're better off. So it's for lone parents, the impact on lone parents will be very much based on the number of children, the number of hours they're working, and the earnings. And the other group here who will lose a lot, households where there's a couple who previously had a choice of, for example, ESA or income support, so they can make the most of disability premiums. They will lose a lot when they move over to universal credit, under both universal credit and council tax support. But for most people who are working, their universal credit will go up. It'll be higher than they were receiving under legacy benefits. And so the council tax support goes down. And this is really good news for local authorities, because it means that this support is being met by central government rather than by local authorities. Yes, thanks, Janet. And then there's final group. Of course, we've got some who've got higher universal credit and higher CT support. And I really have been struggling to find any here. People with households with income from borders is one group. And I know there's another group around people who get maintenance from former partners to support the adult rather than the children, because of the different treatment in tax credits and in universal credit. But this is a very small group. The impact on costs then, as I mentioned, how this will affect you and how this will affect each authority will come down to the number of working age claimants who are employed or self-employed. And the higher proportion you've got of these, the higher natural reduction in cost you will have. So with the London Borough we've been working with recently, the 45% of the caseload were employed and self-employed, and the self-employed themselves were very high at 17%. And they saw a cost reduction of 12%. So if they just kept the default scheme, they would be facing a cost reduction in 12%. But another borough council that we've worked with, which only had 13% of their caseload employed and self-employed, the cost, if we were looking at 2 years ahead, basically rose in line with council tax liability. So there was no reduction that would have happened naturally by remaining with the default scheme. And the only way we can look at this, the only way you can tell the impact for your local authority is to do some analysis based on changing all these households over to universal credit and looking at the groups who are worse off and better off. And I think my colleague Juan will be talking about some of the work we've done with local authorities to get that impact analysis later on today.
Yeah, thanks, Zoe. Hi, everyone. My name is Juan. I'm a policy analyst here at Policy in Practice. I've been doing a lot of this sort of work with a lot of local authorities, modelling CTR schemes. One of which has been Wolverhampton Council, and Jenny has been kind enough to come on today and tell us a little bit about kind of their experience and what they've learned. So I thought the first thing I'd ask Jenny, and actually follows on quite nicely from what Zoe was talking about, given how much the kind of local characteristics of your cohort or low-income cohort can affect, how the default scheme affects you. I wonder, Jenny, if you could just give us a bit of a sense of what the Wolverhampton low-income cohort looks like, just for context, so including kind of people, demographics, and even kind of socially and economically.
Okay, so here in Wolverhampton, we have 110,000 households, and we've got a caseload of nearly 30,000. The split between that is 44% pensioners and 56% working age. But within our working age caseload, 75% of all working age are passported currently, which is quite high. We've got quite high unemployment in Wolverhampton, although it is improving. At the moment, employment in Wolverhampton is 66%, but the rest of the West Midlands at 72%. Nationally, unemployment is 74.5%, so we are quite lower than our neighbours. We've got a housing benefit caseload, which is reducing, ever reducing at 23,000. And our main households in our caseload are 70% social sector. So we've got quite a few challenges here in Wolverhampton. We neighbour with Dudley, Sandwell, Birmingham, Coventry and Solihull and Walsall, and we're part of the combined authority with them. But even with our neighbours, we're quite different demographically. So having one on board and policy in practice has been useful for us. So economically, it's on the way up, but at the moment we've got some issues that we need to be dealing with here at Wolverhampton.
Okay. Yeah, I mean, certainly I remember one of the things that I picked up and which surprised me about Wolverhampton and its demographics was, like you said, the low level of employment. I think it wasn't quite as low as that 13% that Zoe mentioned, but it was certainly around 15%, I think. So that's it's interesting to note how that went on to affect, kind of the impact that the different models had, which I'll talk about a little bit later. So Jenny, could you just give us a bit of an overview of what your current CTR scheme looks like and what changes you've made since CTB?
So we changed, like most people, back in 2013 with the minimum payment of 8.5%, and we really didn't do much else at that point. So we went with the default scheme. We've since increased the minimum payment to 12% and then on now to 22%. But we have got some exceptions that we protect people with disability income and single people under 25 and disabled children. So within that, we've also got a capital limit of 6,000, and we have non-dependent charges still, but we increase those slightly by a percentage each year on the normal default. One of the things that we are finding is making a difference when people move to universal credit is that we only disregard the first child benefit. So we're finding that that's impacted on people. We've also got a taper of 23%, and we've restricted support to band C, and we only backdate for 4 weeks. So we've made lots of tweaks over the years, but we've had the current scheme now since 2015. So we were really thinking that now with universal credit went full service, but finally rolled out here last week. So the last 50% of job centres went last week. That we really needed to do something about where we go with our scheme for 2019-20.
Yeah, that's good. So yeah, you sort of actually preempted my next question slightly. So you mentioned that universal credit was a big driver for you to continue your scheme. Could you just speak a little bit more about that? Is it specifically the concern around administration costs, or was
That's right. Yeah, like most people, it's the universal credit full service, the rollout and the volumes of work, but also the reduction in the admin grant, and looking at where the reductions in subsidy will be happening along the way, where we lose overpayments, etc. And then we'd been a live service since February last year, and we'd noticed that the volumes of work were increasing, and really that has followed through now this year since December, the increase in volumes. But that's not the overall. I think the admin grant and the dealing with the administrative input that's coming through from Atlas, there's high demand. So really looking at what we can do to cut back on the administration.
Yeah, I mean, it's quite amazing that just so shortly after going full service, you're already noticing that that kind of surge in work. So why did you decide to kind of to model CTR schemes with policy and practice specifically?
Okay, so we looked at in the market really to see who was out there, and the main reason really is to give us a broader outlook of what's available and different perspectives. And we thought that policy and practice gave us a wide ranging view and of what was available. We also thought it would be a good idea to get an external point of view to take things back to leadership and members, so that we've got information to back up any decisions that we might want to recommend in the future. Also, there was quite a few references from other authorities and quite differences in modelling that had gone on with other authorities. So it's quite a flexible tool, and we found that it's been really quite flexible with us so far, because we've been able to model two schemes to start with before we've had to decide on making any real decisions about what another model might be. So I think that's been really beneficial for our point of view.
Yeah, I mean, and actually, just for context for everyone, so we usually do model kind of 3 or more schemes for local authorities, but we're actually still working with Wolverhampton, because we modelled 2 initially, and then, you know, whilst kind of everybody involved kind of mulls over the results, we'll be revisiting the 3rd scheme kind of later on. So. And actually, I think this would be a good point to talk a little bit about. If you could give us a bit of detail of what models we've done so far for you, and whether, and kind of a little bit of kind of what the results were and whether they surprised you or not.
Okay, so what we went with rather one which was to do nothing and just keep the scheme as it is, and look at what would happen with people that move over to universal credit. Obviously that, well, not obviously, but that did show that there would be an increase in costs across the board. Then we also modelled a scheme that's currently out there with another council, South Gloucestershire, which they've been good enough to let us come along to their authority and look at what they're doing. So we thought that might be quite a good idea to look at that. But that came out with some unexpected results for us, because obviously our demographic, our caseload, households, the incomes were very different to those people in that area. So the results came out that would not be a scheme that we'd be looking at the moment. But we'd have to do further work or tweaks around that. It particularly came out for children, workers with children would be worse off. So then we put forward another banded scheme, which was a lot of tweaks to reflect that what we'd already got in our default scheme, and then put other things in, like taking out the non-debt charges and other things like that. So that came back with some surprising results again about families with children. So what we're going to do now is just take time to sit back and reflect on all of the information that Juan's provided for us before we go any further with anything.
So have you got any ideas so far? And I know we were talking a little bit about this just before the webinar, but have you got any kind of idea or sense of where you'll take the scheme so far, kind of given the information you have?
I think what's been surprising is how it affects how the modelling has affected different households. So we really need to sit back and reflect. What we're also realising is that we don't really know how universal credit is going to impact longer term. I think getting the modelling through and has pointed us in that direction. So we're thinking that we were going to look at 1920 to introduce a new scheme, but we're thinking that maybe we'll go with a much lesser change and then looked for 2021 to make when we're in a better position to know how our caseload is going to look at that point. So we're looking at maybe the de minimis changes and some tweaks to our default scheme, and maybe some changes in how people apply and how people reapply or don't reapply because of the 6-month issue with the linking period for UC. We're finding that's particularly becoming an issue for us. So I think that's what we're going to be doing, but we haven't made any firm decisions yet.
Okay. So then finally, I think I just wanted to ask you, so what what do you wish you'd known kind of 12 months ago, kind of that you know now, kind of in terms of or around kind of CTR and the impact of universal credit, or conversely, kind of what advice would you give to somebody considering changing their CTR scheme today in response to universal credit?
I think that you need to get, well, from my point of view, I think we thought we knew what scheme would fit our service, and really when you get the information back and you look at the demographics, it really brings it home to you that you've got to really tailor everything for your particular area, and what suits somebody else, even in the neighbouring area, isn't going to suit you. And we did have a meeting of the local councils here a couple of weeks ago where we all really came to that conclusion, because we did think maybe we could all work together on having a local scheme for so that it makes it easy for people to move in and out of the borough. But I think we came to the conclusion you really need to know who your people are and what their circumstances are before you can think about moving on to a new scheme.
Yeah, I mean, certainly, and what you mentioned before about the South Gloucestershire scheme that we modelled as your Model 1. I mean, I did a quick look on kind of their demographics, and it is kind of quite different, and specifically, I think the average kind of number of children that households have there is lower than in Wolverhampton. So perhaps that's why kind of that scheme, which maybe didn't support households with children or couples with children as much, wasn't as much of an issue there as it would be somewhere like Wolverhampton.
That's right.
Something like that is obviously quite important to know. But great, I think that's it from me in terms of the questions. Thank you, Jenny.
Okay.
So I'm going to move on now. So I just wanted to speak a little bit in more detail about the types of modelling that we do. So kind of 4 different types of approaches or models that we do. So the first one, which we've already spoken about a little bit, is the option to do nothing, kind of let time run its course and just continue with the default scheme. Secondly, kind of making small tweaks, both as a means to kind of making small savings, or also to start to prepare the scheme for a more radical universal credit adaptation in the future. And the kind of 3 and 4 kind of more related approaches, so income banded schemes and what we call discount schemes, which are kind of a lot more kind of straightforward, easy to administer schemes that can begin to tackle that issue around spiraling administration costs once UC goes full service. So let me just move on. So just before I get into that, I just wanted to give you a little bit more information on how we actually do the modelling. So we basically use local authority held data, household level data, so the single household benefit extract, the SHIBI, and the council tax data sets. We've worked with, I think, over 60 local authorities now that have provided this data, and we kind of clean them, and then process them through what we call our analytical engine, which is a policy modeling tool which can basically take these data sets as inputs and kind of give us kind of information about that household, either in terms of the benefits they would receive now or under universal credit, kind of compare them side by side, and then also look at different timescales, so both now and in the future. And then, which means that if specifically we're interested in the impact of different council tax reduction schemes, we can look at that kind of in combination with other kind of policy changes that might be going on at the same time. So we have a very, very full view, and crucially, that is at the individual household level. So we kind of build up the picture using the most kind of basic indivisible building block, which is a household. So after we do that, the first thing that that we do actually is so we make sure that the engine that we're using to model your council tax reduction scheme is doing exactly what your current scheme is doing. So we kind of make any necessary tweaks. So in Wolverhampton scheme, for example, we made sure that the maximum level of support was that they were using. We introduced a band cap at band C. So we make sure that with the data that they provide, once we run it through our engine, we are getting exactly the same spend on exactly the same people as what they're sending through in their council tax reduction data set. After that, then, one of the things that we are often asked to model, and which I think is particularly telling, is this. So kind of what would happen if we just fast forward to 2019-20, keeping the default scheme or the scheme as or the default scheme with its particular local tweaks, and just let kind of time run its course and nothing else. So the only things that would actually be changing then are kind of external things, such as council tax liability increasing, things like the national minimum wage or tax allowances going up, which would then impact incomes and ultimately impact the CTR people get. Modeling a certain percentage of households over to universal credit. So we usually kind of decide this percentage kind of in discussion with the local authority. So we have a bit of information of kind of what the average rate of migration is in areas that have been full service for a while. But if there's reason to think that locally it might be faster or quicker, then we kind of usually rely on that. And then other things such as rents going up or benefits rates going up, such as DLA, that might change between now and 2019-20. And generally what we find is actually that not doing anything can have a very, it can actually be, and this is quite a nice way to put it, possibly one of the most radical things you can do. And crucially, and as Jenny was saying, and Zoe, this can vary a lot from local authority to local authority, depending on local demographics. So namely, the amount of people that your low income cohort has in work, that has a very kind of profound impact, because as Zoe was explaining, a lot of those people might gain under universal credit such that their CTI goes down. And then when you kind of add that up across the whole of the scheme, that might mean significant savings for the local authority. However, for local authorities such as Wolverhampton that don't have that many households in work, that then translates into keeping the default scheme and not doing anything as not making very many savings at all. And it's effectively just costing as much as the cost increasing in line with the CT liability increase. So the kind of second other type of modeling that we do is kind of making smaller tweaks to the scheme. So this might be, a lot of the time, this is in response to just wanting to make what are relatively easy tweaks in order to make some savings that you can reinvest elsewhere in the scheme, or just save altogether. Or it can be sort of tweaks that we're aware will come under universal credit anyway. So this kind of being a way to kind of get ahead of those changes and kind of anticipate or see what the impact would be kind of ahead of them just kind of rolling out with universal credit. So these can be things such as introducing a band cap or reducing the capital limit if that hasn't been done already, changing the maximum level of support or minimum payment or the taper rate, reducing non-dependent deductions or just removing them altogether, just as a quick way to kind of simplify administration, or in anticipation of universal credit, beginning to introduce the minimum income floor to all self-employed people, whether they're on universal credit or not, given that that will happen anyway, And actually, a lot of local authorities that I've been speaking to recently have said that they actually see that as a fair kind of thing to do because of what they know about the kind of incomes that they tend to report locally. So an example of this would be a council that we've worked with in the past few months in the Northwest that actually wanted to make the 4 tweaks that you see here kind of in combination as one of their models to see how much that would save them, and then kind of plug those savings back in order to increase the minimum payment, to decrease the minimum payment. So what these 4 changes meant, and they affected overall over 1,000 people, it meant that they could reduce the minimum payment slightly from £3.50 a week to £3.22 a week. So actually, I think that equates to maximum support going up from, I think, about 83% to 86%, more or less. So that's just small tweaks that we can model. And then one of the things that, and this is, as Zoe was saying, something that we've been doing a lot recently as kind of interest and kind of concern for spiraling administration costs kind of takes hold, is kind of maybe more radical changes to schemes, which kind of both reduce the number of reassessments, and when those reassessments take place, make sure that they are kind of a less complex type of reassessment to begin with. So one of the ways that we've been doing this is by modelling income banded schemes, which is basically, and I'm sure most of you have heard of this, and there's a few of them out there already, such as South Gloucestershire. It basically entails totaling up a household's income and then sorting that household into kind of different bands, each with a corresponding level of support. So one of the difficulties that we encounter with this is that naturally households that are bigger are just going to have a larger income just because they have higher needs. So one of the things that these sort of schemes need to be able to do is to somehow account for these kind of higher needs and factor in some sort of protection for larger households. So typically households with kids, for example, that just receive kind of certain benefits that they need. So one of the ways that we actually got around this, that they get around this, both in South Gloucestershire and in one of the schemes we modelled for Wolverhampton, is through disregarding certain types of incomes that are associated with larger families, so child benefit or the childcare element, and actually the housing element as well. Another way this could be done is by equivalizing income. So this basically means dividing that income by the number of household members, so that for a larger household, say a household with 5 members, you're left with an income that you use or that you compare that is kind of more representative. Or you could actually start to introduce slightly different bands for different household types. So single people, for example, could just kind of be cut off sooner in terms of their income than couples with children. One of the things to bear in mind with this sort of scheme is that it could actually end up being quite complex depending on the number of these sort of measures or kind of protections for larger households that you put in place. So something to bear in mind is that, a lot of the time we kind of propose this sort of scheme in order to simplify administration. But if you find that you're having to put in quite a lot of different tests and assessments in order to protect larger households, you might wind up with a different scheme, but which is complex in a different sort of way. So that's something to bear in mind. And then for both kind of this sort of scheme and the discount scheme that I'll speak about in a second, what we can do is actually sort of reverse engineer how we calculate the income bands and the levels of discount for each, so that the cost of this scheme is kind of roughly the same as what the cost is now, or at least what it would be if you did nothing, which tends to be a concern as well for councils, because there tends to be a kind of worry that this sort of radical scheme might end up costing significantly more or significantly less, but we can account for that and make sure that we kind of provide bands and discounts that will kind of achieve just the same spend as currently. So the fourth kind of approach, and this is perhaps, I would say, the most kind of radical. I'm not aware of any local authority that is going with a scheme quite like this. So this is discount schemes, which are a little bit like income banded schemes, However, they don't even look at a household's income. They basically allocate a particular discount based on the household circumstances. So again, it kind of there's no kind of reassessment to do, so that when a household when a household's income changes, or when there's a change. Second. Yeah. So the number of reassessments actually would decrease because people's circumstances don't. I'm having a bit of a mind blank. Okay, so I'm just going to talk a little bit about a scheme that we did like this recently was one for a London borough. So we kind of determined 3 different bands, and we sorted households into these different bands based on their circumstances. So that the first band, so this was like kind of a higher support band, would be one for households receiving universal credit and not earning. So possibly the most kind of vulnerable group. They would automatically get sorted in that. So band 2, which had a kind of intermediate level of support, would be for households earning just a little bit, so below the work allowance. And band 3 would be for households that were actually earning quite a lot and would probably not need as much support. So that's kind of what I meant by the kind of, the degree to which you have to look into a household when there's a change is not very deep. You kind of just need to ascertain a few bits of information. So A, whether they're on UC, and B, whether they're earning or not, and C, kind of whether, if they are earning, whether it's above or below the work allowance. So it's quite quickly, when a reassessment needs to be done, it's quite quickly to do that. And again, as I was saying, for the income banded type of scheme, we can also reverse engineer how we design these bands so that the cost of the scheme is more or less neutral. Okay, and one last thing here. So for all these schemes, we tend to do, we always do, in fact, very comprehensive kind of impact assessments, breaking down kind of what the impact of each of these schemes would be by different household types, by different tenure types, by different council tax bands, disability status, passport status. We kind of provide councils with a very kind of comprehensive list of tables, because we are aware that a lot of the time, especially to pass some of these more radical schemes, it is necessary to have very detailed kind of breakdowns and information of the impact of each. So I've put here just a few examples of, for example, how a particular scheme affected different household types in terms of what the average loss was for each household type, and the same for different tenure types.
And I think the point about looking at it in these different ways, the social and political impacts, and giving this information in this type of way really helps with. We've had feedback that this really helps with going to consultation, where perhaps different points need to be made during the consultation process. So being able to pull that information out is really useful.
Okay, so that's about it from me. So just one last kind of slide. So these are just a few of recent kind of councils, a lot of which I've worked with personally, that have commissioned us to do some CTR modelling. And I'll hand back over to Janet now.
Great, thank you very much, Juan. A huge amount of information there. I'm very aware, and you will get. Thank you very much. I see there's a few questions that have come in, so I'll get to those in a second. We're doing great on time. A lot of information. You will be getting the slides and the recording afterwards. But really, I think don't be shy in wanting one of us to give you a call and talk a little bit about in more detail about how the schemes may work for your own individual circumstances. So what I'll do now, we're going to take a tiny break ourselves, and we're going to put another poll, give you another poll, and just ask really, are you planning to change your council tax reduction scheme? So hopefully you can see a poll on your screen now, and the question that we're asking you, are you planning to change your CTR scheme soon? 4 options to choose from. Yes, going to change the scheme for implementation in 2019-2020. Secondly, yes, for implementation in 2020, 2021. Yes, but not in the near future. And no, not at all. Thank you very much, everybody, for the votes coming in. I can see, I'll leave it just a little while longer. I think really, just while people are voting, Juan, any thoughts on the people that we're working with currently when they are looking to implement?
Yeah, a lot of them that we're working with currently were kind of thinking for 1920. I mean, just because of the kind of timescales now as such that, you know, there is enough time for this to be quite an iterative process. So for them to kind of come back and ask for a little bit more information on a particular scheme or to do a tweak on a particular scheme. So I would say mostly for 1920, but increasingly 2021 as well. And there have actually been a few councils that we've worked with in the past that have that wanted modelling for kind of, I guess, this year, so 17, 18. So I know of one in the southwest, for example. So yeah.
I think those results on the screen are quite interesting. Zoe, would you like to take over and make some comment on those results?
Yeah, I think it's everyone's bit, you know, the sensible approach is to look well in advance. And 1920 is certainly well, we're discussing with most local authorities at the moment. I do think it will depend on where local authorities are with universal credit. There does seem to be a sort of, some local authorities want to introduce the beginning of universal credit, but universal credit has its own challenges. We were hearing that from Jenny, the amount of additional work. That I think a lot of local authorities are thinking, let's just tweak for 1819 and move over to a new scheme in 1920. There's also the political impact we've got to look at, that depending on how your local authority elections are set up. For many authorities, what will happen in May will determine which way they go. So they might be modelling at this stage, ready to give some sort of guidance to any incoming administration, but actually the decision can't be made till after, and so then they'll be looking at 1920 or 2021.
Excellent, Zoe, thank you. Let me get rid of this slide now, and then we can move over to the conclusion slide, Zoe.
Yeah, I just to draw together really everything that we've heard. The big point is that this, just maintaining the current scheme won't be neutral in terms of the social impact, and whether the social impact is politically acceptable to your authority probably needs a bit of investigation. There is going to be a social impact. People will be better. Some will be better off. Some will be worse off. There will be an impact on cost, and really, with universal credit, as universal credit moves towards full service everywhere. Managed migration starts, it's probably at least worthwhile knowing what that impact will be, so that your elected members can make a decision about whether that impact is politically acceptable. And the best scheme for an authority, and we heard this from Jenny with looking at another local authority scheme. We found this ourselves. I mean, we're quite astonished. I started way back being very against localized CTR. And as time's gone on, I'm seeing more and more the advantages of it, because what works in one area just doesn't work in another, not just because of the political sensibilities of the local authority, but the demographics have a huge impact on a scheme that, in fact, if you've only got a few people being hit by some decision you've made on scheme design, you can put money into DHPs or some other CTR emergency support or some other sort of welfare support that's discretionary. But if you've got a large number being hit, that's really not possible, and will negate any admin savings that's been made. So all these things have to be taken into account, and actually every scheme has to be looked at on a local level rather than just imported from another authority.
Great, Zoe, thank you. Thank you very much. So I think now what we've got some really interesting questions that have come up, and I'm sure as we start asking questions to our speakers today, there will be that might prompt you for more questions. So just to kick us off, I have a question here, Juan. Juan is over my shoulder and can see exactly what the question is. Now that question will mean more to you.
Yeah.
So do you want to read out the question?
Yeah,
and
I'll
then
read out the question. So this is it in the prescribed scheme that we need to process all changes in circumstances at the time effective from the change date, or can we save up changes to UC and process, for example, every 3 months to reduce the number of council tax bills issued? So my understanding is that you cannot save them up unless you make a change in your council tax schemes, such as introducing a de minimis rule, which would allow you to save them up and look at them every 3 months. But under the prescribed scheme, my understanding, I'm not sure if Zoe, you can kind of contribute a bit to this as well. My understanding is that you're not allowed to do that under the prescribed scheme.
No, I think you're quite right. If you're just keeping the default regulations, it's up to you. It's a localized scheme. You can just change your default regulations. They're only there for if a local authority doesn't set a scheme or for you to use as a basis of a scheme. You can just change them and put your assessment. You could change them to write in there that you're using average income. You can write in there that you're going to assess every 6 months and that the benefit period based on the assessment will be for however long you want, or you can write in there that you're having a de minimis rule. You can do what you want with those changes of circumstances, but legally they have to be in your scheme.
Yeah. So basically, yeah, if you want to kind of process them after 3 months, that has to be reflected in your scheme. Legally. Which is, I think, Jenny, I think was one of the things that you were considering doing for now, kind of whilst you kind of wait to see the long-term impact of universal credit. Is that right?
Sorry, I may have
Hello? Hi, Jenny, are you there?
Yes, that's right. We would, if we were thinking of doing that for 1920, we would have to go back and change the scheme and get approval for that before we could do anything with that. I'm guessing there might have to be some consultation in there as well.
Thank you, Jenny. I'm very conscious of time. I know we have got questions in, and we've got more questions than we do have time for. So rest assured that we will get the answers from the panel to you after the webinar, along with the slides and the recording. But just a couple more questions, if I may, to whoever on the panel wants to answer. Zoe, you talked earlier about software council tax software that looks at the different cost of models. So how is what Policy and Practice does? If you could just draw out how what we do is different to maybe the software that people may already be familiar with.
Yeah, I think the main software suppliers, and we've had a few meetings with them about this to see what we can work, where we can plug the gaps between us. They provide very useful software to look at the cost implications. What they don't allow for is, and I don't think they're intending to, I mean, they know that's, there are organisations like ourselves who do this very detailed data analysis. They can't take into account things like external factors that Juan was talking about, like taking into account changes in minimum wage, tax thresholds. They can take into account CT rises, but it's also the breakdown on impacts. So if you're just looking for the simple cost, what the simple cost will be, excluding external factors, I think most of the major software suppliers do provide that. But I think in order for consultation, for equality's impact, and for informing political decisions, the breakdown into impact analysis is what most local authorities are requiring on top of that.
Okay, and thanks, Zoe. Just any thoughts before we finish up on the questions coming about the timescale for this level? The model sounds very in depth. So how long does it take to do?
Okay. Yes. Generally, we say about 6 weeks from when we get the data. It's very different to say from when the local authority decides to go ahead. We usually start with a discussion where myself, Juan, or one of the other members of the team will come and visit the local authority. We discuss what they're looking at. We let them know how we feel looking at their demographics that will impact their population. We have a long discussion to get to a very detailed idea of what they want modelled. Then once we start getting the data through, it'll take about 6 weeks for us to to match it to their current costs, and then to apply all the uprating changes that Juan was talking about. And often the hold-ups can be in getting the data, but yes, we tend to work with the local authorities to their own timescales.
Brilliant. Thanks very much, Zoe. We're at 11:30 now, and I did promise to have you on your way, so I'm going to leave it there with the questions. And as I said, we will get back to everybody else who's asked questions that we've not yet answered. We'll get back to you after the webinar. And just to finish up then on some next steps, I mentioned there that there is the flyer in the right-hand panel that you can download now that talks a bit more about the service that we've talked about today. And also in the survey that's following, we've got a white paper that we've wrote specifically looking at universal credit and the impact on council tax reduction schemes. So do take time to download that white paper from the survey. We would really value your feedback if you would take the time to just give us some feedback on the webinar to help us develop further, and also ask any other questions as well. You can do that in the survey, and you can actually ask to have another look, put your hand up to have another look, and we'll get in touch with you about the CTRS work. I just wanted also, you can also ask for further information, but I just wanted to let you know here and now that we've got 3 really interesting events just around the corner. It's a very busy time for everybody. On the 9th of March, we have a round table that we're hosting here in Westminster with Neil Munslow from Newcastle City Council and Mark Fowler from London Borough, Barking and Dagenham. And this round table is about improving lives while reducing dependency. So it's quite a strategic look about the state of welfare policy now and what local authorities can do. So if you would like to know more about that and maybe come along to that, please do put your hand up in the survey. And then there's a couple of other webinars, one in March about helping disabled job seekers on their journey into work, and that's looking at our software, our calculator software. And then in April, looking at our data analytics service, which helps people to proactively tackle homelessness. More detail in the survey. Yes, forgive me cantering through that right now. So all that remains is for me to say thank you very much to our speakers today. Zoe Charlesworth from Policy and Practice, Jenny Hall from Wolverhampton City Council, and Juan Alvarez Villanova from Policy in Practice. It's been great to have you on board. Thank you very much, everybody. You will be getting the webinar and the recording and the slides in an email later on today. So thank you very much. Take care and have a great rest of the day. Thank you. Bye-bye.